Okay, let's jump right into this explainer and uncover why Japan is currently facing what looks like an inescapable economic puzzle. If you follow global finance at all, you've probably noticed some pretty startling headlines lately about the Japanese yen and their central bank. Well, today, we are going to break down the exact mechanics of this crisis. We're going to use the history, the data, and the context to show you how a trap, literally 30 years in the making, has finally sprung shut. You know, there's actually a famous joke among economists that perfectly sets the stage for us today. It goes like this. There are 4 kinds of economies in the world: developed, undeveloped, Argentina, and Japan. And that's because for the last 3 decades, Japan has been a complete anomaly on the world stage. They've just been completely defying economic gravity. They haven't behaved like a standard developed economy, and they definitely haven't followed the normal rules of money. To really understand why they get their own special category, we just need to look at one massive number: 200%. That is Japan's government debt to GDP ratio. It makes it one of the absolute highest debt burdens in the entire world. Over the years, they've printed and borrowed just absurd amounts of money. Now, in any normal textbook economy, doing this would instantly invite massive inflation or cause an absolute panic in the bond markets. But for Japan, for a very, very long time, absolutely nothing happened. So here's our roadmap for unpacking this today. We're going to cover the economic anomaly, decades of stagnation, the inflation shock, the crashing yen, the bank's impossible dilemma, and finally, selling the family silver. Section 1, the economic anomaly, defying economic gravity. To get our heads around this crisis, we first have to establish Japan's baseline, which is a staggering 30 years of zero inflation and zero growth. Basically, to get this frozen economy moving, Japan's central bank, the Bank of Japan, or BOJ, bought up billions of yen's worth of government bonds. They were essentially just printing money and handing it directly to the government to pump into the economy. Normally, as we all know, printing lots of money leads to inflation. And actually, scratch that, inflation was the BOJ's exact goal here. But instead, both Japan's inflation rate and its economic growth rate stayed stubbornly glued near zero, all while that massive debt pile just kept quietly growing in the background. Section 2. Decades of stagnation. How we got here. So, to trace the mechanics of what's happening right now, we have to rewind back to the 1990s. After a huge period of rapid growth, Japan suffered a series of really quick economic shocks. Property prices in the stock market essentially collapsed, which triggered that long period of stagnation. Moving into the 2000s and 2010s, that's when the BOJ stepped in with their massive money printing experiment, causing the debt to just balloon, and everything stayed frozen in this weird, highly indebted stasis right up until early 2022. Section 3. The inflation shock. A cure becomes a fever. Then, in 2022, an external global inflationary shock swept across the world. This pushed Japan's annual inflation rate above 2% for the first time in nearly a decade. And ironically, Japanese policymakers originally hoped this would be a good thing. They wanted it to trigger what's called a wage price spiral. This is basically a cycle where workers demand higher wages to compensate for higher prices, which gives households more spending power, which in turn drives prices up just a bit more. In their absolute best case scenario, the Bank of Japan hoped this would permanently lift their baseline inflation from 0 up to a healthy 2% target, basically encouraging people to finally spend their money instead of hoarding it. But unfortunately, that cure quickly became a fever. The spiral ended up being way more severe than expected. Wage growth for unionized workers came in at 5% for the past 3 years. And on top of that, continuous global shocks, like the conflict in Iran, added even more external price pressure. Because of all this, inflation hasn't just politely touched 2%, it has hovered well above the BOJ's target for most of the past 4 years. And this persistent, elevated inflation has started causing some major structural problems. Section 4. The crashing yen, a 40-year low. That persistent inflation leads us directly to the absolute most visible symptom of this crisis, their currency. The Japanese yen has been falling steadily since 2022, and it recently plummeted to a staggering 40-year low of 163 against the US dollar. Now, that is great news if you're a tourist buying sushi in Tokyo, but it's a total nightmare for the Bank of Japan. So we have to ask, why is the yen selling off so rapidly? Well, part of it is simply that inflation naturally erodes the real value of any currency, but the more fundamental reason lies in how the Bank of Japan reacted, or honestly didn't react, compared to the rest of the world. To put that into perspective, we just need to look at the massive gap in global interest rates. When global inflation hit, basically every other central bank in the world fought it by aggressively raising interest rates. They wanted to encourage saving and suck money out of the economy. The US hiked rates up to 5.5%. The EU went to 4.5%. But Japan, they held their interest rates at a negative 0.1% and only very recently nudged them to a barely visible positive 0.1%. Japan has by far the lowest interest rates in the developed world. And that massive interest rate gap, it instantly triggered capital flight. Think about it. If you're an investor, it is significantly more attractive to save your money in dollars or euros, where you can get a solid 4 or 5% return, rather than holding Japanese yen for basically zero return. So, investors naturally sell off their yen to go buy higher yielding currencies. This puts immense, relentless downward pressure on Japan's money. Section 5. The bank's impossible dilemma. The trap springs shut. So you might be wondering, why doesn't the Bank of Japan just hike their rates like the rest of the world and solve the problem? Well, because doing so triggers an inescapable mechanical trap. Let's walk through the steps. If the BOJ raises interest rates, it encourages people to save. That means there's less money sloshing around for anyone trying to borrow, including the government. This mechanically leads to step 2. Bond yields go up. And that instantly triggers step 3. Japan's massive 200% government debt pile becomes significantly more expensive to service. In short, they literally cannot afford the interest payments on their own debt if rates go up. This means the Bank of Japan is caught in an absolute catch-22. They are effectively forced to choose between 2 total catastrophes. On one side, you have a currency crisis. If they keep rates low, the yen continues to plummet, which makes importing goods ruinously expensive for normal people. On the other side, you have a bond crisis. If they raise rates to save the yen, their gargantuan debt becomes unserviceable and they risk a government default. Normally, high inflation and a depreciating currency should naturally invite higher interest rates, but Japan's highly precarious fiscal situation makes that practically impossible. And any alternative tricks to wiggle out of this, they just make things worse. If they try to artificially cap yields, Japanese bonds become even less attractive to international investors, which just pushes the yen down further. If they just print more money to buy bonds and keep yields down, that injects more cash into the economy, causing even more inflation. And to make matters even tighter, the Japanese government recently signaled a desire to borrow even more money in the coming years. There is simply no easy exit strategy here. Section 6. Selling the family silver, avoiding acute collapse. So, with this trap firmly shut, how is Japan staving off an acute fiery collapse right this very second? Well, they are spending massive amounts of money trying to fight the tide. The Bank of Japan recently spent an eye-watering $73 billion in a direct market intervention, attempting to hold the yen at 160 to the dollar. But ultimately, these interventions have been completely unsuccessful. The global market is just too big. In fact, these failed attempts have actually undermined the BOJ's credibility with investors. The investors no longer believe the bank can actually stem the decline, which just prompts them to sell off even more yen. Now, a total overnight crisis is unlikely to happen tomorrow morning for one simple reason. Over the past couple of decades, the Japanese state has accumulated trillions of dollars worth of foreign assets. They hold a massive safety net. When things get incredibly tight, they can sell off these foreign assets to try and pay down some of their domestic debt, or they can use the foreign currency to intervene and defend the yen in the markets. But as our source material perfectly points out, relying on this strategy is the literal definition of selling the family silver to pay the mortgage. Sure, it keeps the lights on today, and yes, they have a lot of silver to sell, but every single time they dip into those foreign assets, they are depleting their emergency reserves. It leaves the Japanese state completely unprepared and highly vulnerable to any future global economic crises that might come their way. Which leaves us with a critical, looming question to take away from this explainer today. Japan has spent 30 years defying economic gravity, but gravity always wins eventually. When those foreign assets run low and the family silver is gone, how will Japan escape a trap where both raising rates and keeping them low lead to disaster? And more importantly for the rest of us, what happens to the entire interconnected global economy when the world's 4th largest economy finally runs out of tricks? It is a fascinating, incredibly precarious situation, and it's one we are absolutely going to be watching closely.